if we look at the difference between the two strategies, if we talk about trend following strategies first, just to give you an idea of kind of how we break this down, what we're trying to identify first is a primary trend. We're using a longer period momentum typically to identify that longer term trend. We're taking a look at usually technical indicators such as a momentum indicator where we're looking at maybe 30 to 50 periods out. So we're taking at least 1 to 2 months worth of price action to determine whether a stock is trending higher or lower. So positive or negative momentum would suggest either a positive or bearish trend. And then what we're looking for is a pause in that overall trend. We're looking for either a shorter term momentum or some type of moving average that tells us that the primary trend has either consolidated or paused. And that's going to give us the signal to potentially look at entering that primary trend. And what we're looking for is a resumption of that primary trend. We're looking for a resumption of that primary trend. So we're looking for a moving average or short period momentum to reverse back towards the primary trends. And the way to think about this visually is if you have a stock that's moving higher, what you're looking for is a bit of a pause or some kind of a pullback where the risk reward is more favorable to enter rather than entering a trade near top and hoping to chase it, right? Because stocks never move in one direction. They move higher and they usually take a pause and consolidate before they continue moving higher. And what you're trying to identify is pullbacks like this to give you a better risk reward for that trade entry. On the flip side, if you talk about counter trend, what we're looking for are trend extremes. Now, trend extremes are basically, every momentum indicator will tell you when something is technically overbought or oversold. Those are quote unquote price extremes. But we tend to find that if you just look at a single indicator, that's usually not enough and you get a lot of false signals. So to identify a trend extreme, we usually look at both shorter and longer period momentum. So we'll usually look at something like a daily and a weekly chart. And what you want to see is a stock basically near overbought or oversold conditions, not just on a daily chart or not just on a weekly chart, but combined on a daily and weekly chart. Those give you far better trading signals. And what you want to do is and many times just finding an extreme level in itself is not enough. You need to find trend exhaustion. You need to see that and the reason for this is because many times you just have a stock that's doing incredibly well and it's got strong momentum here on both short term and long term, and chances are it's going to continue to run in that overall direction. What you need to find is trend exhaustion. Signs that the buyers are starting to get exhausted, meaning there are fewer and fewer buyers stepping in, or as sellers, fewer and fewer sellers stepping in. And that is the moment at which you have the highest chance of that big reversal in the opposite direction. Not easy to identify, but we're going to show you kind of the template for how to go about doing that. And then lastly, I do think that for traders who really want to try to find the best trading setups, you want to also align with some kind of fundamental thesis. So understanding the fundamentals of a company will be incredibly helpful with that, because if you have identified a stock that you think is at an extreme in terms of high and you think it's going to reverse lower, well, maybe looking at some of the fundamentals, meaning look at what the valuation of the company is. Look at the outlook that the company is providing from a guidance perspective, outlook on the industry, economic indicators. These are all things that can help you, give you some clues that something has reached a price extreme that's gone too far, and it's likely going to reverse in the opposite direction.